Thank you, Madam Lerner Driver, President. Our guest speaker today, I'm sure, is known to everybody, so my job's very easy. Put up your hand if you've never seen, met or heard of John Shewan. My job's completed. But in case there's some of your knowledge which is missing in your mindset about John's activities, strong involvement in the Institute of Chartered Accountants and the accounting profession, that culminated in his role as being chair of PwC from the turn of the century through the decade that followed. But his interests go much beyond that. A specialisation in tax has taken him into many fields nationally and internationally, and you'll have all been aware of some of the reports he did insofar as the overseas taxation issues associated with that. And then Victoria University, our major tertiary provider in Wellington, has likewise had a lot of John's skills and time spent up there adding to their business advisory programs and the degrees that are offered, the qualifications offered at Victoria. More recently, John took up the role as being chair of the Wellington Regional, the Westpac Regional Stadium, a role you've had now for 5 years, I think, at least. And so the growing success of that is very much due to the efforts that John had previously being on the board and now as its chair. And he's going to now give us the opportunity to give us some understandings about why those of us who have property interests in the Wellington or the central part of the North Island completely are getting the messages when we go along to our brokers to get the reinvestment or reinsurance undertaken. They say, don't blame us, don't blame the prime insurance, blame the reinsurance people offshore. So John, the floor is yours. You're welcome.
Thank you very much, Nigel. I'm interested that this is a short form meeting. I thought that's very appropriate for a subject which probably you don't want to hear too much about. When Chris Parkin first approached me about speaking today, I said, why would you wish to ruin a good lunch with a discussion about insurance? But sadly we are where we are, and I thought what I would do today would be to, I need a bit of a flipper or something to move the slides on, or do I just do it on directly on the side? I'd just like to...
No one gave me slides.
Oh, okay. Sorry, Rebecca had some slides loaded, I thought. Maybe not. So look, I'll just carry on while that slide hitches address, but there are some slides. But the only reason there really are slides is I wanted to put the New Zealand and the Wellington insurance situation into context, because we focus too much on our own little areas, which is understandable. But it's very much a global industry, obviously, and in fact the only reason we have insurance is because of the global industry. The role I play in, and I'm chair of Munich Reinsurance in this part of the world. So Munich Re, as the name would suggest, is a German reinsurer, head office in Munich, otherwise fondly known as Mother to be obeyed. And the Australasian operations are run out of Sydney, and it's my privilege to chair them, and I've been on the board for some 6 or 7 years. And Munich Re is, together with Swiss Re, they're the two largest reinsurers in the world. And although New Zealand only generates 0.1% of global insurance premiums, unfortunately we punch well above our weight in terms of profile, level of losses and level of potential losses. And the first slide that'll come up hopefully shortly sets out a table you really don't want to be on, but it's the 10 biggest insurance events in the last 30 years. And that's the top 10. And you don't want to be in the top 10, but we are. And the reason we... Thank you very much, that's great. The reason we are on that list is that we come in at number 9. And number 9 was the Littleton earthquake, the second of the big quakes in Canterbury. The insured losses from that quake were 16.5 billion US, which puts us at number 9 on the league table for the last 30 years. If you combine the other two Canterbury quakes, the total losses were 26 billion US, and that would make us number 7. The other comment I'd make about that slide is you'll see that the other major events are either earthquakes or hurricanes or floods. Hurricanes are an increasing source of major claims globally, and there's some absolutely enormous numbers coming through there quite recently in the US. Hurricane Irma, Harvey and Maria, all in 2017 with close to $200 billion US of losses, so some very big numbers. So, regrettably, we do feature on this table, and that obviously is not lost on the global insurers. A fact that's not well known about the way we insure for earthquakes is that actually we have the highest penetration of insurance globally. So New Zealanders and New Zealand businesses are more comprehensively insured for earthquakes than any other nation on earth. And the stats show that there. If you look at the first three lines there, they're the three big Christchurch quakes. And on average, the insurance recovery from those quakes was 71% of the total losses. If you roll down to Japan, who sadly had that huge earthquake shortly after the Christchurch earthquake, their insurance recovery was only 19% of the total losses. The big quake in Turkey back in the late 90s was only 5%. So New Zealand has this extraordinarily high level of earthquake insurance. And one of the questions I want to address today is, can that continue? Because we are very much an unusual scenario. I remember shortly after I joined the board at Munich Re in Sydney, one of the German colleagues was over, and at one stage in the meeting he said, "Can Mr. Shewan please explain why only New Zealand has a 1 in 200 year event every year?" I tried to reply a bit flippantly by saying we're also very good at producing rugby players in the form of the All Blacks, and it was completely lost on him because he was a soccer fan. But the interesting thing about the way the Germans viewed that period of enormous losses coming out of Christchurch was not the fact that there had been quakes, because that's the business we're in. We expect disasters. That's why we live, how we survive. But what unsettled the industry globally was the fact that Christchurch changed the whole modelling parameters for earthquakes. It produced a number of highly unusual events, liquefaction being one of them, that simply hadn't been foreseen. So the Germans' concern was, how do we get the modelling so wrong? So Christchurch has had an enormous impact on earthquakes insurance globally. There's some other unusual features of the New Zealand market I'd like to draw attention to, because we're at risk of this changing unless we play our cards carefully. I've already covered the penetration rate, but there are 4 other factors on that slide. One is the fact that it's still reasonably easy to get earthquake insurance on buildings in Wellington and other parts of New Zealand. It's becoming obviously more expensive. It's not a pleasant experience negotiating it, but it's still widely available. In Japan and California, and these are the 2 other areas that are compared with New Zealand, the big 3 for earthquakes are Japan, which has a higher risk than us, California, which is about the same as us, and ourselves. So we're in that gang, whether we like it or not. So at the moment, we're enjoying the fact that we can get cover, whereas it's quite heavily restricted in these other 2 big seismic areas. The second area of real notice and relevance is business interruption insurance, which is so critical. You basically can't get it in Japan now for earthquake insurance. It's simply not available. In California it is, but it's a lot more expensive than New Zealand. And my fear is, because of the experience of recent years, that we will see business interruption insurance, the premium costs will inevitably, I think, rise. The third area where we're quite different is the area of deductibles or excesses. How much do you each pay on your own claims? Now, on buildings in the Wellington area at the moment, very broadly speaking, the deductibles are about 5% of the insured value. That is quite unusual. In Japan, it's about 5%, and they're quite unusual, and that's changing. In California, it's 15 to 25%. And I think we will see insurers increasingly encouraging or maybe requiring deductibles to increase. Certainly through my role at Westpac Stadium, which Nigel referred to, that's happening. I want to come back to the stadium because it demonstrates very clearly the kind of issues we face as Wellingtonians. And then the final and the really big one is premium rates. I mean, I know no one in this room wants to hear it, and I didn't want to believe it myself, but relative to our 2 cousins, Japan and California, our earthquake insurance premiums are still very, very low, and they will increase. So rates for earthquake insurance in California are typically 1% of reinstatement value, the insured value. In Wellington at the moment, they have risen, but they're broadly in the 0.3% to 0.4% range. And that's about where Westpac Stadium is at the moment. But if you increase it upwards, these premiums become quite formidable. So from an overall perspective, I suppose the question is, we understand that there's going to be price increases. I'll come back to how we go about calculating prices. and we're seeing that with renewals. But the bigger worry that I've had for some time is there a risk that the global insurers will simply say, we just don't want to be in New Zealand? Why bother? And it's a pretty good question, because when you look at recent experience, I'll come back to that slide. When you look at recent experience, this slide was, the numbers on this slide are different from the earlier ones because these numbers are extracted from the New Zealand Insurance Council database, and they're in New Zealand dollars, and they only include losses that are written directly in New Zealand, so they exclude losses written by Lloyd's and offshore providers. But to put it in context, and for those who think the insurance industry is ripping the nation off, if we look at the last 18 years, the Canterbury and Kaikoura quakes collectively resulted in losses, just local losses, of 24.1 billion. The earthquake insurance premium over the same period was 5.8 billion. And out of that 5.8 billion, the local insurers retained about 38%, 2.2 billion, and the rest, 3.6 billion, was paid to companies like Munich Re, Swiss Re, Berkshire Hathaway, the offshore reinsurers. In the insurance business, there's a term loss ratio, which, as the name suggests, it's what's the ratio of your losses to premiums. And once you get up over 100%, you're losing money. You know, it's not hard. So the loss ratio over the last 18 years in New Zealand for local insurance companies insuring earthquake risk is 146%. For the reinsurers, the Munich Re's of this world, the loss ratio is 527% over the last 18 years. And the reason it's so much higher for reinsurers is that we take the catastrophe level cover, so you'd expect it to be much higher. So if you put it into context, in 2010, the premiums were set for the Canterbury quakes, which occurred in 2011. It would take 103 years of 2010 level premiums to pay back the losses that were incurred on the Canterbury quake. So they're stunning numbers. And with the Kaikoura quake more recently, a much smaller level of loss, and premiums have increased, it would take 4 years to repay that loss. So you look at that slide and you say, well, is there a risk of the insurance industry globally saying we'll just exit? I think the answer to that is no, and I'll come back to the reasons for that, but clearly there is a pricing response that we've already seen. So price movements in New Zealand over the last 8 or 10 years since the Canterbury quakes are shown up there. You'll all recall that there was quite a significant spike in insurance premiums. They went up just under 300%. And then an interesting thing happened in 2014, they began to fall. Before I come on to the reasons for that, the very sharp rise here, this jump, reflected a complete risk reweighting of New Zealand. I mentioned that Christchurch or the Canterbury quakes produced some unexpected consequences. The global insurance industry had an army of engineers and actuaries look at all of that, and as a country we got re-rated. That's what caused that spike. In contrast, this increase we're now experiencing, this unpleasant increase which I think will continue, that does not reflect the re-rating of New Zealand. The Kaikoura quakes were within accepted modelling parameters. They were getting out towards the extreme ends. The length of the quake, 2 minutes 40 seconds, highly unusual by global standards, but broadly, Kaikoura did not cause the global insurers to say we've got New Zealand wrong in terms of our modelling. So why are we seeing such sharp increases? It's not a spontaneous knee-jerk reaction. It is simply a reflection of capacity. You've got a number of, and the consolidation of the insurance industry locally hasn't really helped. You've got a number of insurers that are saying in particularly prone areas, such as Wellington, our capacity at the moment has reached a limit, and they, at the moment, don't want to write new business. And there's been one major carrier made an announcement recently on home insurance. I think that will be temporary. Why did we see that big drop between 2014 and 2017? That was a surprise, but it reflected a lot of capacity in the global market. So we're totally dependent on global events with insurance. And what happened in about 2014 was a whole lot of new players came in. Global premiums had spiked, the market did its job, and there were new players came in. The Chinese came in quite big time into the market. There were hedge funds and pension funds got into insurance. Berkshire Hathaway expanded significantly. So now, I know some people don't like the market, but actually it kind of works. And when you get a lot of extra capital coming in, insurance premiums come down. So, what's all this mean now in terms of pricing, and how does it impact Wellington? The most significant development in recent years is that technology has meant that we can be much more precise now as to exactly what causes losses and where they are most likely to arise. So advances in technology, earth sciences, and also we have a lot more data points on earthquake insurance. We've had a lot more earthquakes. Engineers like the real thing because you can model all you like, but the real thing is what produces the goods in terms of predicting what might happen in the future. So we've now got far more precise information, and that information is far more localised. So we have a small army of experts based out of Munich who come over here quite frequently. They have far more localised data than you expect. You could go to our head office in Munich right now and they could within seconds put a map up of the Hutt Valley and tell you exactly where the earthquake's is likely to cause most damage if it hits. Now what that is causing is far more localised pricing. So the sort of cross-subsidisation that many of us in this room have been beneficiaries of, I like nothing better than the thought of Auckland as paying my insurance premiums. I think this is great, and I think it should continue. But those days kind of are slowing down because of the far more precision available in terms of the data. Now, the bad news there is that it clearly gives rise to a significant affordability issues. And there are some really sad stories of elderly people in apartment complexes that simply can't afford the hikes in insurance that are occurring within body corporates. And it ripples through the Wellington and the Wellington region. And that is a very, very serious issue. So what are we going to do about it? First point is I don't think it's a case of panicking and thinking, gee, we're getting to a stage where we're living in an uninsurable city. The market is ensuring that's not the case. I've talked about the international capital and the fact that there's been a significant increase in the level of capital available. I think that will continue, and the low interest rate environment kind of helps in one sense. But we will have these capacity constraints where individual carriers say from time to time, no, I'm not willing to increase my cover for my capacity in Wellington for a particular time period. But I think it will be time limited, it won't be a permanent adjustment. And even when that happens, and we're seeing it right now, home insurance in Wellington, there's been some scaremongering about the fact that new previously uninsured people can't get home insurance. My son and his partner were in exactly that camp, and they were turned down by a couple of the traditional players, but there's several new players have already emerged on the market. So the market will do its job, and it will react, and is reacting. So I think the supply will continue, but it is going to be expensive. Final comments I'd like to make is just where to from here. I've already indicated I think prices will continue to rise. And I come back to the Westpac Stadium example. Insurance is our single greatest cost by some margin. When the stadium first opened, insurance was about $100,000 a year. Post-Canterbury, it spiked up to about $900,000. It came down quite significantly, and in 2017, I think the premium was about $515,000 for a building with a value of just over $200 million. Since Kaikoura, that's gone up by 120% to $1.45 million, and that really hurts. You're running a charitable trust. You suddenly got a $900,000 increase in cost. You've got to sell a lot of. Some people debate the quality of the food, but you have to sell a lot of food to pay for that. And I think as Wellingtonians we face some significant challenges in terms of discussions around affordability of insurance and to what extent do you insure these assets. And the unusual thing about the stadium is it's a standalone asset on reclaimed land. We have no portfolio effect unlike sort of other businesses. So it's quite a challenging issue, and our trust spends a huge amount of time on seismic issues and insurance. So what needs to change? What's going to happen? So these are comments from my German friends who helped me with this presentation, and this is not just New Zealand, but it's happening globally, and particularly California and Japan, and here being more seismically exposed. Changes to terms and conditions, things like deductibles going up, that's likely. Building codes. The Germans are pretty grumpy about building codes in terms of both their quality and compliance therewith. And I think we're seeing the whole construction industry in this country getting a good shake-up. Clearly it needs that. That may lead to some price rises in the industry generally, but in terms of insurance, I think we'll have a far stronger focus. So if you're looking to insure a building, ensuring that you're totally compliant clearly is essential. If you're building a new building, the whole area of mitigation, the only way of reducing insurance premiums and making them more affordable is to reduce risk. It's not hard. Insurance premium and risk are directly correlated. That's the business that we're in. So to reduce risk, you need more mitigation steps. It's very interesting talking to people like Mark McGuinness from Willis Bond, of course linked to LT McGuinness, the kind of steps they're taking with the new buildings down on the waterfront. Those are the kind of initiatives that the insurers take pay a lot of attention to, direct correlation between premiums and the amount spent on risk mitigation. But you know, the reality is that the days of the government and the private sector insurance companies carrying 100% of the risk are over. It's simply not realistic. I agree with Tim Grafton of the Insurance Council on that score. I think we need to have a conversation between local and central government, private property owners and insurers about what we're going to do about this. It's a three-way deal. The insurers will continue to provide some support. The Earthquake Commission is regarded as a world-leading sharing platform, and I think that will likely expand. And I think we'll likely see the emergence of some quite innovative solutions too, some of which will be supplied by the insurers. In the climate risk area, which is the other biggie which I haven't had time to talk about today, there's a lot of work going in. For example, there's one cover we offer now where, and it's very popular with local authorities in Australia and in Europe, whereby you automatically get paid out if winds exceed a certain level. If they get over X kilometres an hour, your cover cuts in and you simply get paid out, no questions asked. And there's all kinds of interesting things like that coming onto the market. So, as they say, the times they are changing. We don't need to get too gloomy, but we just need to be realistic about who we expect to share our risk. And sadly, as I say, we can't expect our fellow cousins in Auckland to carry on cross-subsidising us the way they were. Thank you very much for your time. I'll be happy to answer any questions.
Stay there because we do have time for some questions, and this is obviously a topic of great interest to us at multiple levels. John, your hand's up first.
John, banks currently require, in the main, if you're a reasonable mortgage, 100% of earthquake risk. That is becoming, as you've mentioned, increasingly hard to find. In fact, we're right in that position at the moment. We did mention banks being in the talking regime. I believe they need to be included.
Yeah, I have a slight conflict of interest. I'm involved with a bank, but you're quite right, and they do know that, and the Reserve Bank's focused on that as well. So I'm quite impressed by the work Reserve Bank and Treasury are doing in this area. I think my personal view is, not to be attributed to the bank I'm associated with, that the expectation of 100% insurance, earthquake insurance, is unrealistic. But banks, like the insurers, are obviously looking at risk, and there's other ways of managing that risk. But I think that has to change, as it's an unrealistic expectation.
John, it's excellent talk. To what degree are insurers like yourselves focusing on sectors such as earthquake and making the premiums paid out so that it's self-contained with an earthquake? I thought insurers were able to diversify between fire and flood and earthquake and all the other things. So you wouldn't try and look at just earthquakes as an input-output model. No,
that's quite right, and we do diversify, and actually, diversification, I forgot to mention in my address, I should have, that New Zealand, one of the reasons insurers like New Zealand is that we do offer diversification in terms of obviously geographical region, but more broadly, diversification across product lines. The only reason you can afford to pay out costs like Canterbury is because you've made profits in other areas of your business. So there is, over time, well, on a year-by-year basis, there's significant quotes cross-subsidisation. However, in insurance terms, basic insurance principles suggest that you should not, over any period of time, write a product which you know is going to be unprofitable. That just makes no sense. And as the Royal Commission in Australia has identified, not explicitly but certainly implicitly, if you're say giving discounted if you're not fully covering your costs on earthquake insurance but you're charging people more for fire insurance as a consequence, is that fair on the fire insurance consumers, on the people that are only buying fire insurance? And what Justice Haynes said in Australia is that actually, consumers need to know about the products that they're buying. Are they subsidising others? And so, from an insurance point of view, you would not wish to be doing that. You wouldn't wish to be selling unprofitable lines, but certainly on a year-by-year, month-by-month basis, cross-subsidisation is happening all the time. That's the way we survive.
Your name doesn't have to be John to ask a question. Any others? John, thank you. And Roger.
Well, thank you, John. As we expected, a lot of information came through there which will help us better understand why it is we pay much bigger bills, and hopefully the risk that we have has now been passed on to Auckland or somewhere else. But anyway, thank you very much for being along here with us, and I hope you enjoyed the staying and interaction with us here today.